Hi, my name is Cliff Hodge, Chief Investment Officer with Cornerstone Wealth Group. Thank you for joining us for our September flash update. Given that there's been somewhat of a hurricane in financial markets and now an actual hurricane in my backyard, we wanted to reach out with a message directly from the investment team to all of our clients. Our thoughts and prayers certainly go out to all who have been affected by Hurricane Ian. And what's most important right now is that everyone is taking the necessary precautions to ensure their physical safety and the safety of their loved ones, while we do everything that we can here behind the scenes to manage the safety of your portfolios. There's no question that this has been a challenging time. Markets and portfolios are down. And while we have already taken steps to reduce risk across the board, and can take some solace that our clients are not bearing the full brunt of the market sell-off, we get it. No one likes to be down. No one likes to open up their statements and see a lower balance. And in times like these, after these sell-offs, our instincts can be to throw in the towel and to abandon our long-term plan. But history tells us time and time again that is typically the worst decision that can be made. In times like these, it's important to keep a long-term perspective, and that can certainly be a challenge. But after all, that's why we invest. We invest for the long term to achieve our long-term goals. So if you haven't done so, please, I would encourage everyone to reach out to your advisor, have a conversation, make sure your financial plan is on track. Don't take any drastic actions without doing so. We're certainly going to get through this. It's been a rocky time. Speak with your advisors, and then please join us for a more in-depth webinar on October 13th with my partner, Jeff Carbone. So with that, we'll dive in. One of the questions that we've been getting a lot is what's been the driver of the additional volatility that we've got over the past couple of months. And in our mind, it's the fact that the market has finally accepted the Fed and Fed Chairman Jerome Powell at their word that they are going to continue to aggressively hike interest rates and use monetary policy to slow the economy with the primary goal of quelling inflation. In and of itself, this means that recession odds, unfortunately, are rising. We think this is what the market is starting now to price in. Monetary policy is somewhat of a blunt tool. Interest rates are the primary mechanism with which the Fed can affect the markets and can affect the economy. And as a result of globally coordinated policy, interest rates around the world have skyrocketed. This brings equity valuation down and increases uncertainty. And we're likely to still see volatile markets here over the near future, both to the upside and the downside, especially around these inflation releases that we're going to be getting over the next couple of months. Inflation has been the major story for the better part of 2 years, but now our focus is shifting to growth, both on the economic side and the earnings side, and then more importantly, expectations. We strive on the investment team here at Cornerstone to always skate to where the puck is going, not to where it has been. Inflation is where it has been, and economic growth is where it's going in our minds. That's really what's going to be the key drivers for the next leg in financial markets. So briefly, here's a quick update. This is as of yesterday, September 29th. The S&P 500 is down 23%. And what has made this sell-off even worse is that bonds have failed to provide the diversification benefit that we've gotten accustomed to over the last 20 years. You can see the U.S. aggregate bond index, which is like the S&P 500 for the bond market, is down 14%. And the reason for that is, again, this sticky inflation narrative. The world's 60-40 portfolio, which is often seen as the world's retirement portfolio, is down 20% year to date, which is the worst on record, at least going back 75 years. And what I've highlighted here on the chart of the S&P 500, this was the August Jackson Hole meeting, and then the September FOMC meeting, where the Fed delivered their third 75 basis point rate hike of 2022. And that wasn't the surprise. 75 basis points was baked in. But what was surprising was what the Fed communicated to us via their summary of economic projections, which I've highlighted here on the left-hand side of the screen. And there are a lot of numbers here, but really the key takeaways are slower growth, interest rates higher than expectations, higher unemployment, and sticky yet falling inflation. And what was really quite shocking was what the Fed communicated to us in the unemployment numbers. So if you look on the graph here, estimating a 4.4% unemployment rate both in 23 and 2024, which may or may not be palatable on its own. That's about a 0.7% increase from where we are, where we troughed in the unemployment rate at about 3.5% or so. That equates to between 1 and 1.5 million more jobs lost. So we looked back at, as we always do, at history and what the markets tell us. And unfortunately, what we see is that the Fed has never been able to achieve those objectives that they're laying out for us. In fact, over the past 50 years, every time that we have seen an increase of just mere 0.5% in the unemployment rate, that has always been accompanied by a recession. So this 0.7% number may sound great in theory, but what we've seen is that, in fact, that 0.5% number is somewhat of a Rubicon, if you will, because once the unemployment rate increases by more than 0.5%, it has always gone on to increase by at least an additional 2%, which, using today's numbers, would equate to about 3 million jobs lost. If you take the average, look back over the past 50 years, every time we've gone north of a 0.5% increase, the average is a 3% increase in unemployment, which would equate to about 4.5 to 5 million additional jobs lost. So that's the risk. Now, that 3% number that was certainly skewed by the global financial crisis in 2008, we are not anticipating anything in the realm of that magnitude, even if we were to slip into a recession. As we'll see here in the next couple of slides, the economy is in much greater shape than we were in 2007, even than we were in 99 and 2000 before the dot-com recession. So that, if we do slip into a recession next year or in 2024, we think it's likely to be quite mild. So as I mentioned, the Fed impacts the economy and markets primarily through their interest rate policy. This green line here looks at the yields on treasuries at different times across the curve, from 1 month going out to 30 years. Green line is approximately where we are today. The yellow line is where we were a month ago. So as you can see, pretty drastic increases in both the 10-year yield, going from 3 to now about 3 3/4. And even more so on the 2-year yield, which was at about 3 3/4, it's gotten up to now 4 1/4 or 4.5. So the Fed's monetary policy has a direct impact to equity market valuations, as we can see here on the right-hand side. This dark blue line is the PE ratio, price to earnings ratio, of the S&P 500 based on next year's earnings estimates. This light blue line here are treasury yields, and we'll notice that this axis is inverted. So in fact, as this light blue line falls, that represents interest rates increasing. So we can see, on the good news front, that a lot of the heavy lifting in equity valuations has been done. We were at 22 or 23 times earnings back last year. We're now down to about 16 times next year's earnings, which is more in line with longer run valuations. So again, we think a lot of the heavy lifting for the S&P 500 from a valuation standpoint has been done. Now we are really focused on growth, economic expectations around this E, or around the earnings number. So what we've done here is a bit of scenario analysis. We spend a lot of time on the team here at Cornerstone looking at various paths that the economy and that markets may take. And we've gamed out a couple of different scenarios on the soft landing side and on the hard landing side. And given all the volatility, this graph here, which we've incorporated from Goldman Sachs, is already a little bit out of date. We're actually right now about 3650 on the S&P 500. And so if you look at the chart on the left, 3650 on the S&P kind of coincides with a soft landing scenario with the broader equity markets, which would then mean that if we are able to achieve this outcome, that equities actually look fairly attractive here, and we could have some material upside going into the fourth quarter, going into next year. The problem or the risk to this scenario is that hard landing scenario, right? Even if we stay at current valuations, or if valuations come in a little bit more down to 15, 14 times next year's earnings, what we're really going to be watching very closely is the earnings estimate. So right now, consensus is pricing in a 7% year-over-year increase in earnings for 2023. But when you look back historically, what happens on average during recessions is that earnings actually fall in the neighborhood of 12% on average. And so if we do go into this hard landing scenario, as a result of slower economic growth, lower earnings, higher unemployment, there could be some additional downside in equities. Though, again, much of the heavy lifting has already been done in our estimation. Now, I certainly don't want to paint the picture that everything is all doom and gloom. That's certainly not the case. There are certainly some positive aspects of markets and the economy that we also wanted to share with you today. The first being this chart on the left. And we showed this during our kickoff event, but by and large, the markets are following the script for midterm elections, and that you expect from January through October a lot of chop, a lot of volatility, perhaps even negative returns. Granted, not to the tune of 20+%, but going into election season and after the election, you typically get a bit of a relief rally, especially in periods where you have a split or a divided government, which is currently what is the expectation, that the Democrats will obviously retain control of the White House, but the GOP may flip either the House, the Senate, or both houses of Congress. So that would certainly be welcome to risk assets into equity markets. A couple of other aspects that are really positive is that households still have just an exorbitant amount of excess savings, to the tune of roughly $2.3 trillion in excess dry powder, which is good for 8 to 9% of our annual GDP. You also look at deposits at commercial banks. So consumers are flush, financial institutions are flush, corporates are actually in great shape as well from a leverage perspective. We just are not seeing a lot of the buildups that we see in prior pre-recessionary periods. So given this data, again, this is one of the primary reasons why we do think that even if we were to fall into a hard landing or a recessionary scenario next year, it's likely going to be pretty mild, which would be great for financial markets and the broader economy. So we'll leave you with just a couple of key takeaways. One, we know that the Fed is purposefully going to slow the economy to bring inflation under control. Soft landing is still on the table, but recession odds are rising. So we're going to continue to focus watch like a hawk economic growth and labor market data, especially as we now go into earnings season. We think the third quarter, fourth quarter are going to hold up quite nicely from an earnings perspective, but we're really going to be focused on guidance, what companies are telling us about the future, and then what their plans are from an employment perspective. As we mentioned, the puck is going where we think the puck is going is that the market is going to become focused on growth numbers. We've taken down risk, and we're going to stand ready to add risk back as we navigate through what could be a bit more of a volatile period as we get better information. And then lastly, don't panic. Now is not markets have already had a pretty harsh sell-off. So now is not the time to go to cash and completely throw in the towel and bail out on your financial plan. We invest for the long term, keep the long-term perspective in mind, talk with your advisor about things that you could perhaps do at the margins to help you sleep better at night. But don't abandon the long-term plan because of the volatility. And then last but not least, please join us on October 13th at 4 o'clock. Myself, my partner, Jeff Carbone. Looks like we could both use some updated pictures there, but we will go a lot more in depth on this webinar on the 13th. So thank you for your time. Thank you for the opportunity to come and work for you each and every day. We understand that this is a volatile period. We get it, that it's stressful, but again, would encourage everyone, reach out to your advisor, stick with your plan. We're going to get through this thing to the other side, and we think returns and thus portfolio balances are going to be set up for success here over the coming months and years. So with that, we'll sign off. Have a great weekend. Thank you.